Hey everyone, today we will be going through the hottest stock of the entire decade, Bath and Body Works. Now, their earnings are coming up soon. I want to look into them, see how their last report did, see kind of what we're expecting, go over their financials, and then we'll take a look at their chart, see where we think it might want to go. But overall, make sure to subscribe. This is Bath and Body Works. All right, so starting off here, obviously I think most people know what Bath and Body Works is. It's like fragrance products, a little bit of hygiene products, soap, things like that. One thing to note with them is that they are at least I'm sure they're expanding into online, but they're mostly like a mall store as far as what I'm aware of them. Like they're mostly found in like malls and outlets, something like that. But I can't imagine this is going to be the greatest review, but we'll have to see. I mean, target price is at 42 and they're at 30. So that is something. They do have a positive long-term growth rate. Let's get into the income statement, see how that's looking. So overall, looks like sales have not been where they were in 4 years, just about. Actually, wow. So they have taken a very, very significant hit to their sales over the last many, many years. Now, one thing to note with this, which some people may not realize, net income is actually increasing. So 2015, they had $1 billion in net income, 11 billion in sales. Now they're at 7 billion in income, and they're still just under $1 billion in net income, which is definitely something to think about. But overall, 4 years of declines, straight declines, and even still before that, it was way, way higher. They have not even nearly recovered from COVID and have in fact declined further, which is terrible. That is terrible. Now, operating income looks a little bit not as horrible. They're clearly doing an all right job at cutting costs. They have recovered, it looks like, very, very slightly in the past year, but still doesn't warrant me giving them a decent score. And then for net income, they've recovered significantly over the past 2 years. That is honestly very impressive, even. They're making more money despite a fraction of the sales. That is very impressive. So overall, I'm really not going to go too crazy into this, but I just want to look. So it seems like their January quarter is seasonally their very, very high one. That's what it seems to me, at least. So I'd imagine very soon people will be buying in. But overall for net income, I think I'm going to do the 0.5 only because I'm going to give it the full score because they've clearly cut costs so significantly that they're still making the same net income despite having basically almost half of what their sales used to be, a little bit more than half, but still. For EPS, again, same thing. EPS is significant. It's been increasing over the past 2 years. That's honestly kind of impressive. All right, this is going to be another one that is kind of shocking to me. Their total shares have been going down. They have been buying up their shares. That could definitely also affect their gross income, which could be something there, but they have been purchasing their shares back. As you could see, it was at 270. It's at 220 now. That's, again, also helping out their EPS there, which is not necessarily the good or bad thing at all, but it is definitely helping out their EPS. In terms of cash, it looks decent, at least decent enough to cover their short term. For their assets, it looks like they've been selling off pretty significantly. But again, net income, they're probably selling off their underperforming stores. They're cutting ties with underperforming segments or whatever assets that they have that aren't doing well, and they're keeping the highest performing ones. So their net income is going up, their assets are going down, which is crazy to think about, but that is how they're working out. Short-term debt looks good for their cash situation. Their long-term debt, however high it is down a lot from where it was, which is crazy to think about. So I know it's high, but it has been decreasing so consistently that I'm still giving the full credit there. And then for their retained earnings, it is actually not great, shockingly. But again, a negative retained earnings is not the end of the world either. Let's go into their cash flows, see what we see. Should be seeing some share repurchases, as I'd imagine. So again, operating cash flows, they have been declining fairly significantly. Looks like it's mostly just, again, caused fully by funds from operations. So, I mean, they are still positive, but they are declining. Investing cash flows, it's basically just CapEx, which that is whatever. It looks like they have started purchasing some investments a little bit in 2024, which is good. Financing cash flows, again, changing capital stock and reduction of debt. That is fantastic. That is amazing for them. And then free cash flows, looks like we had a little bit of a recovery in the past year, but overall not great. I'll probably do the half credit there because their net income is still increasing. As long as they're cash flow positive, that is good. That's all I'm going to say. So for the use of cash, again, we're seeing very significant. Now, another thing to say, which is kind of shocking, they have held their dividend through all of this. It looks like they may have decreased it very slightly. This is in the past year, by the way, but they have held their dividend through all of this. Now, it has decreased a fair bit, but at the same time, they're still paying it out to their shareholders, which in this kind of situation where your sales drop that much, it is pretty impressive that they are. So repayment of debt, again, is phenomenal. I'm loving it. And then obviously repurchasing shares is very, very good as well. Let's just head right into the ratios and see what we see. I'm assuming SGA to sales is going to be much better, and it looks like it is not actually. It is above their 5-year average at the moment, which doesn't seem to have affected their net margin, which is a little surprising. But again, SGA to sales is above at the moment. It looks like their net margin is pretty significantly above. You could see their margin in 2015 was 9%. It's now almost 12%, and it has stayed fairly consistent, although it used to be higher. But again, we're also seeing their net income increase over the past 2 years. So that is no big deal there. They are above the average, which is good. ROA, ROE looks pretty solid, 16% compared to the average of 9% over the past 5 years, which is really good. That is excellent. And then long-term debt to total equity is pretty good. Obviously, they have a lot of debt, and I don't think I think they have negative equity, possibly. If we, let's go back to the balance sheet for one moment so I could see. And yeah, they do have negative equity, which is mostly just because of the retained earnings and not a lot of common stock par value, but that really is no big deal. If we go back to the ratios. So overall, not a crazy deal with the whole debt to equity there, but I think I'm just going to do the 0.5 because their debt has been improving and their retained earnings are most likely going to be starting to go up, and that's where they'll get the equity from. So that is definitely something to look at there. So overall for Bath and Body Works, kind of a unique one. definitely unique. 73, 16.5 out of 23. What is it? BBWI 73, which honestly I was not expecting. I was expecting them to be a lot worse. So this is all pretty solid. We usually don't see it like this where, assets are decreasing, sales and operating income are really bad, but then things like their cash flows were fairly solid, repurchasing a ton of debt, repurchasing a ton of stock. Like that's something that we do not see very often. So just knowing that they're doing that most likely could probably turn around their stock in the next few years. Now, again, I'm going to go into their chart first here as we move away from the financials. Their stock price has suffered absolutely. Definitely towards 2020, they were actually kind of saved by COVID, if you really want to look at it that way, where they were declining for years and recovered from it. And now they're kind of in a middle area where they could possibly break out, cut enough costs to continue moving up, see their income turn around. Hopefully, they're already starting to see it. But let's go into their recent earnings report and see what that looks like. Now, I believe their earnings are on 21st of November is when the preview came out. So this is the preview for their earnings report coming up soon, which I believe is November 25th. So that is Monday. So this video should be up either on Monday or Sunday afternoon, depending on when I feel like posting it. But let's look at the estimates. So revenue, 2.5% increase year over year. That's pretty solid. Operating margin, 13%, which I believe is roughly what we were seeing if we go into the ratios. Actually, that's a pretty significant decrease. So hopefully they beat on that, because at the moment, that's years. So sorry, that's years. You also have to remember they are a January quarter outperformer. So, for example, they always have much more sales in their January quarter. But if it does end up being 13% operating margin, that is significantly lower than what we've seen in their past three. So that's not great. Quarter four, it looks like they'll be bringing it back. I believe, this is for their Q3 earnings. So gross margin 46%, and then guidance for 2025. Now this is big. Negative guidance, they're predicting 4 to 2% negative revenue growth, which is not great. That's really bad, honestly. But hopefully we see some outperformance there. Maybe they increase it to positive growth, in which case the stock will probably explode. But you never know there. So let's go into their last earnings report and see what kind of results they delivered there. So metrics recap. And it looks like they really don't have a lot here for us. Just gross margin beat, SG&A was a little high, and operating margin beat as well. So we do want to continue to see that operating margin outperform for them, because that will translate into the net margin. That'll translate into more profit. So hopefully we do end up seeing that. But overall, I think that's all I have for Bath and Body Works. I hope you enjoyed. Hope you learned something. Make sure to subscribe if you haven't, and I will see you next time.